Let us study the second accounting standard, which is titled as Valuation of Inventories. This accounting standard is created with the following two objectives. 1. To provide a guidance for determining the value at which inventories are to be valued in the financial statements until related revenues are earned. 2. Provide guidance on the cost formula that are used to assign cost to inventories. This standard applies to all inventories except the below given items, since separate standards have been individually assigned for its implementation. A. Work in progress under construction contracts. B. Work in progress in the ordinary course of business of service providers. C. Financial instruments as stock in trades. D. Livestock, agricultural and forest products. All other inventories are valued and presented in the financial statements according to the principles listed under Accounting Standard 2. We have understood that AS2 deals with the valuation and presentation of inventories in the financial statements. First of all, what are inventories? AS2 defines inventories as A. Assets held for sale in the ordinary course of business. This means finished goods. B. Assets used in the process of production for such sale. These are termed as work in progress. C. Assets in the form of materials or supplies to be consumed in the production process or in the rendering of service. These are termed as raw materials. Since we have learned what inventories are, it might be easy for us to think of various inventories in different industries. For example, in a car manufacturing company, automobiles are the inventories since they manufacture and sell it in the ordinary course of business. For a textile shop, clothes and garments would be the inventory. For a vegetable shop, vegetables are its inventories. In a manufacturing company, the raw materials used for the production and goods processed halfway can also be called as inventories. Inventories remain as one of the major financial areas in most of the enterprises, and hence clear instructions has to be given pertaining to its valuation and presentation. This would result in uniform and identical treatments of inventory in the financials. This enhances comparability and uniformity. So, how should inventories be valued in the books of accounts? The standard instructs us to value inventories at the lower of its cost and net realizable value. What then is the cost of inventory? For finished goods, cost is a summation of cost of purchase of its raw material, cost incurred to convert those raw materials into finished goods, and other costs necessary to bring the inventory in present location and condition. For work in progress, it is a summation of cost of purchase and cost of conversion. For raw materials, its cost is the cost incurred for purchasing the raw material. Net realizable value is the total amount receivable on selling the inventory less other selling expenses. It is easily understandable that net realizable value can be estimated only for finished goods and not for work in progress and raw materials, since they cannot be normally sold in the market. Hence, generally lower of cost and net realizable value applies to finished goods inventory alone. Work in progress and raw materials are usually valued at cost. However, if the net realizable value of the relevant finished goods is lower than the cost, the relevant raw materials and work in progress should be written down to net realizable value. In such circumstances, the replacement cost of the materials may be the best available measure of their net realizable value. Replacement cost is the cost to be incurred to replace the assets at the same or equal value. We have learned that cost or net realizable value, whichever is lower, applies only to finished goods, since raw materials and work in progress is generally not saleable. Let us now see how to find the cost of finished goods. Cost has three elements: cost of purchase, cost of conversion, and other cost. Cost of purchase includes the purchase price plus all other necessary expenses directly attributable to purchase of inventory like taxes and duties, carriage inward, loading or unloading charges, less any expenses recoverable from the supplier or government. For a trading company, cost of finished goods is just the cost of purchase as mentioned before. However, for a manufacturing concern, cost of inventory includes cost of conversion. Cost of conversion is the sum total of direct labor, factory variable overhead, and factory fixed overhead. Direct labor is the cost of workers who are directly associated with the production process. The sum of direct materials cost and direct labor cost is termed as prime cost. Overheads are indirect expenses related to the production of goods. The two types of overhead are variable overheads and fixed overhead. Variable overhead are those indirect expenses which changes in proportion to the production. Examples include electricity, indirect materials, indirect labor, etc. Indirect materials are those materials which are either not an integral component of goods or have a very small physical association with the main product. Example, oil lubricants used in the running of machinery, light bulbs used in manufacturing machines. Indirect labor is the cost of employees who are not directly linked with the production of goods. Examples include wages of custodians, supervisors, electrical maintenance employees, etc. The second type of overhead is fixed overhead, which are the types of cost which remain same irrespective of the production or sales of the company. Examples are insurance premium, fixed salaries, rent of the factory premises, etc. The third factor in the total cost is other miscellaneous costs which are incurred to bring the goods to present condition. This includes packing charges, logo printing charges, etc. Hence, the total cost of a product manufactured is direct materials plus direct labor plus variable factory overhead plus fixed factory overhead plus other miscellaneous charges. However, there are some costs which are explicitly excluded from the cost of inventory. These include selling and distribution cost, storage cost, unless those costs are necessary in the production process prior to a further production stage, administration overheads, which do not contribute to bringing the inventories to their present location, abnormal wastage of materials, labor, or other production cost. Borrowing costs that are directly attributable to the acquisition, construction, or production of a qualifying asset are included in the cost of the qualifying asset. Qualifying assets are those inventories that necessarily takes a substantial period of time to bring them to saleable condition. Examples of qualifying asset includes a power plant which will take a substantial period of time to get ready to generate electricity, a toll bridge which can take a couple of years to construct before it can be opened for the public to use, a hydroelectric dam that takes several years to construct. Sometimes a single production process may result in one or more products. In case this additional product is intended item and has a good market value, they are known as joint products. If this additional product doesn't have a good market value, then they are considered as byproducts. In case of joint products, total cost incurred for producing the joint product is allocated among them using some rationale like ratio of sale value of those products in the closing stock. However, in case of byproducts, the net realizable value of these byproducts is reduced from the total cost so as to arrive at cost of the main product. We have learned before that inventories are valued at lower of cost and net realizable value. We have been looking into the ways of finding cost per unit of the inventory. Now let us see the method of finding the total cost of inventories using the cost per unit. For example, assume that we are a manufacturing company and hence produced a batch of 10,000 units of finished goods with a cost per unit rupees 10. Next day, we continued the production and then produced another 10,000 units of finished goods at rupees 11 per unit since the cost of materials had risen then. We sold 7,000 units of finished goods to a party on the third day. What would be the cost of our inventory then? Is it 1,40,000 or 1,43,000 or some other number? To know it exactly, the standard has prescribed certain cost formulae which has to be opted by every company in the valuation of its inventory. These are FIFO, LIFO, weighted average cost, specific identification method, standard cost, and retail method. These are the various options available to the entities to be chosen for valuing their inventories. Let us now see what each one of them stands for. First in, first out, abbreviated as FIFO, is a method under which whatever is received first is issued first. Hence, closing inventory is valued at the rates for the equivalent units purchased at the last. Last in, first out is a method under which whatever is received at last is issued first. Hence, closing inventory is valued at the rates for the equivalent units purchased at the beginning. Weighted average is a method of inventory valuation where cost per unit is assessed by dividing the total cost of production or purchased by the total number of units. Specific identification method. This is a method of inventory valuation which is suitable where one unit of inventory is not interchangeable with another unit. Each unit is valued specifically on its original cost. Examples for such goods are shipbuilding, machinery building, etc. There are two more cost formulae or techniques of measurement of cost suggested by the accounting standard for some special cases. These are standard cost method and retail method. Under standard cost method, inventories are valued on the basis of set standards which are realistic and reviewed regularly. In retail method, inventories are valued at the selling price, which is then adjusted with a normal gross profit ratio and selling expenses to reach at its cost. Till now, we have seen the methods used to arrive at the cost of inventory. The second part of the question is the value called net realizable value. How can it be found? Net realizable value is the estimated selling price in the ordinary course of business less the cost necessary to make the sale, that is selling expenses. For example, ABC Limited has manufactured goods worth rupees 100. The current market value of these goods are rupees 130. In order to sell these products, a broker has to be engaged by paying him rupees 5 and rupees 10 to deliver the product to customer. In this case, the net realizable value is equal to 130 minus 5 minus 10, which is rupees 115. Hence, in this case, the product will be valued at lower of cost and net realizable value, which is the lower of rupees 100 or 115, and hence the value of inventory will be rupees 100. What exactly has to be disclosed in the financial statements pertaining to inventory? The following has to be disclosed. First, the accounting policies adopted in measuring inventories, which is the lower of cost and net realizable value. 2. Cost formula used, and 3. Total carrying amount of inventories together with a classification appropriate to the enterprise. The inventory should be classified in the below categories: A. Raw material, B. Work in progress, C. Finished goods, D. Stores and spares, E. Loose tools. Let us now do a couple of problems so as to get a firm grip on the concepts we learnt till now. Evening Limited is engaged in the manufacture of ice creams. During the year 2014-15, company ordered 16,000 kg of a material named A at rupees 160 per kilogram, 1000 kg of B at rupees 20 per kilogram, 500 kilograms of C at rupees 30 per kilogram. All these prices includes excise duty of rupees 5 per kilogram, in respect of which full SENVAT credit is admissible. The normal transit loss is 2%. The company actually received 15,500 kg of A and consumed 13,600 kg of it, 970 kilograms of B and consumed the whole, and 485 kilograms of C and consumed the whole amount. The other details of cost of production are as under: wages rupees 16 lakh 40,000, variable overhead rupees 8 lakh, fixed overhead rupees 11 lakh 60,000, which includes interest charges of rupees 55,000, and lastly selling overhead of rupees 95,000. The production resulted in formation of three products which are named P 1,25,000 kilograms, Q 1 lakh kilograms, and a byproduct 32,000 kilogram. Currently the market price per kilogram of P, Q and the byproduct are 80, 50 and 25 respectively. At the end of the year, product P left unsold is 16,000 kilograms and product Q left unsold is 4,000 kilograms. There is a profit of rupees 90,000 on sale of byproduct after incurring separate processing charges of rupees 80,000 and special packing charges of rupees 1,20,000. Rupees 60,000 was realized from the sale of scrap. Along with the manufacturer, Evening Limited sells ice cream in the shops they run. Evening Limited purchases the glass cups for serving ice creams to its customers. While leaving the shops, the consumers leave the empty cups in the shops and the company takes possession of these empty cups. Company has laid down a detailed internal record procedure for accounting for these empty cups, which are sold later by the company calling for tenders. Can we consider the empty cups existing as on the date of balance sheet as inventories of the company and hence to be valued as per AS2, or should it be treated as scrap and hence shown at realizable value with corresponding credit to other income? Also, compute the value of closing inventory as on 31st March 2015. Are there any abnormal losses incurred during the transactions? If yes, how much is the loss and what is the accounting treatment for it? The closing stock in Evening Limited includes the following: raw material A 1900 kilograms, product P 16,000 kilograms, product Q 4,000 kilograms. Byproducts are those products which doesn't have good market value and hence they are normally sold at a lower amount in the market. This amount is generally deducted from the total cost of production. Firstly, let us find the cost of raw material which are yet to be consumed and hence in the stock. In this case, it is raw material A. Cost of raw materials includes the cost of its purchase and any freight or unloading charges incurred for its purchase. In our question, only the cost of raw materials alone is given. However, this amount includes excise duty paid, which can be claimed back as SENVAT credit. Hence, this amount needn't be included in the cost of materials. Let us now see how to find out the actual cost per unit of each raw material by giving effect of SENVAT credit. Name of the material ABC. Materials bought in kilograms 16,000, thousands and 500. Cost of purchasing per kilogram 160, 20 and 30. Total cost of purchase of each material 25,60,000, 20,000 and 15,000, less excise duty which can be claimed as SENVAT credit, that is rupees 5 per each kilograms, which is 80,000, 5,000 and 2,500. Next, we shall find the amount of material after normal loss, which is 98% of the total materials bought for each raw material, since the 2% of the materials ordered are lost during transit. Hence, the figures would be 15,680, 980 and 490 kilograms. We assume that the total cost found before is actually for raw materials received after the transit loss. Hence, we will now find the revised cost per kilogram of these raw materials, which is obtained by dividing total cost of material obtained by lessing the SENVAT credit by kilograms of material obtained after normal loss. This turns out to be rupees 158.16, rupees 15.31 and rupees 25.51. Amount of material received for A, B and C are 15,500, 970 and 485. The amount of materials consumed from the total is 13,600, 970 and 485 respectively. For materials B and C, the entire amount of materials received are used up and hence there are no closing stock for the same. Closing stock of A turns out to be 1900 kilograms. Value of this closing stock is 1900 into 158.16, which is rupees 3,510,000. Along with the same, let us also find the abnormal loss in transit. That means the loss of material in excess of the normal loss. Normal transit loss was given in the question as 2%. Hence, any loss exceeding this 2% is abnormal and hence the same has to be written off through the P&L account. This figure is obtained by reducing the materials received from amount of materials after normal loss, which turns out to be 180, 10 and 5 kilograms for A, B and C respectively. Monetary value of the abnormal loss is the product of abnormal loss in kilograms into revised cost per kilograms, which is 28469.39, 153.06 and 127.55. Now let us see how to find the cost of producing each of the main product P and Q. Previously we have seen that net realizable value of any byproduct in the manufacture has to be deducted from the cost of production of the main products. This is done with the notion that byproduct has very less market value and hence we rarely use the same for anything else. Also, cost of production of joint products is allocated among the individual products based on some rational basis. Example, this might be based on the ratio of sales value of each of those products. Let us see how much is the net realizable value of the byproduct which has to be deducted from cost of production of the main products. Sales price of the byproduct is 32,000 kilograms into rupees 25, which is rupees 8 lakh. Certain processing charge and packing charges are incurred to sell this byproduct amounting to rupees 80,000 and rupees 1,20,000. Hence the realizable value of byproduct turns out to be rupees 6 lakh. Having obtained the net realizable value of the byproduct, let us now see the cost of producing the main products P and Q. First, we will add all the elementary cost, which includes material, wages, variable overhead and fixed overhead. Materials consumed has to be valued at the revised cost per kilogram we found in the previous calculation. Also, fixed overhead excluding the interest is added since we assume that the interest expenses mentioned here are not for qualifying assets. Hence, the results turns out to be rupees 57,23,240. Net realizable value of the byproduct which we found before has to be deducted, which is rupees 6 lakh, and also the sale of scrap amounting to rupees 60,000. The total cost of production is rupees 50,63,240. This is the joint cost of producing both main products P and Q. Cost of production separately for P and Q cannot be found easily since not much details are given for the same. Next, let's see how to allocate the cost between the products P and Q. The idea followed is to allocate the total cost among the main products in the ratio of their total sales value. Output in kilograms is 1,25,000 and 1 lakh for main products P and Q respectively. Market value of them as given in the question is rupees 80 and 50. Total sales value of P is 1 crore and that of Q is 50 lakhs. Ratio between these values is 2:1. Hence the total cost allocated to both the products is 50,000 63,240 into 2 by 3 and 50,000 63,240 into 1 by 3, which is 33,75,493.20 and rupees 16,87,746.60. This total cost is divided between the total output, which gives cost per unit for P as rupees 27 and Q as rupees 16.88. From the above calculations, let us see what is the value of closing inventory of main products. Closing inventory in kilograms for P and Q are 16,000 and 4,000 respectively. Cost per unit is 27 and 16.88. Hence the value of the closing stock is rupees 4,32,063.13 and 67,509.86. Coming to the other part of the question as to whether the empty cups can be considered as inventory. Let's see. Tangible objects or intangible rights carrying probable future benefits owned by an enterprise are called assets. Evening Limited sells these cups by calling tenders. It means further benefits are accrued on its sale. Therefore, the empty glass cups are assets for the company. As per AS2 valuation of inventories, inventories are assets held for sale in the ordinary course of business. Evening Limited maintains a detailed and controlled recording. This signifies its materiality. Hence, inventory of empty cups cannot be considered as scrap and should be valued as inventory in accordance with AS2. Let us now see another problem with which we cover almost 100% of the chapter. Below are given certain information about the raw materials and finished goods of ABC Limited. ABC Limited maintains inventory in periodic inventory method and values it in weighted average basis. Details of purchase of the raw materials are given along with the date of purchase. Details of issue of raw materials is also given with the respective dates of issue. Replacement cost of the raw materials is also given, which is rupees 150. Certain details about the finished goods are also given in the question. This includes the closing stock as 1200 units, materials consumed 220, direct labor 60, direct overhead 40 and fixed overhead rupees 2 lakh on normal capacity of 20,000 units. Based on the data given above, calculate the value of closing stock when the net realizable value of the finished goods are rupees 400 and rupees 300. First, let us determine the amount of closing stock at the end of the period. For that, let us make a table detailing the date of transaction, purchase quantity, sales quantity, and the resulting closing stock. First date is 1st March 2016 on which a purchase was recorded. Hence the closing stock at the end of 1st March 2016 becomes 20. 3rd March 2016 records a sale of 10 quantities and hence the closing stock becomes 10 at the end of 3rd March 2016. Similarly, we can fill up the remaining transactions. The final closing stock after all those transactions turns out to be 20. We are told that the company maintains goods on the weighted average basis. Hence the cost of each unit of the closing stock is found by adding total cost of purchase and dividing it by total number of purchasing unit. This can be found using two additional columns, purchase cost per unit and total cost of purchase. The total cost of purchase turns out to be rupees 8,640, and dividing this amount by the total units purchased gives us rupees 108. This is the cost per unit of the closing stock. In order to finalize the value of closing stock of raw materials, we need to determine the value of finished goods too. If the net realizable value of finished goods is lesser than the cost of finished goods, it's illogical to value the raw materials which are used to make finished goods at cost value. In such a case, raw materials has to be valued at the replacement cost. So let us now understand the cost of finished goods. Materials consumed is rupees 220, direct labor 60, direct overhead 40 and fixed overhead 10. This gives us a total cost of rupees 330. Let us now summarize the cost and net realizable value we have. Cost per unit of raw materials as per the weighted average is rupees 108. Net realizable value per unit of the raw materials which is given in the question is 107.75. Cost of the finished goods is 330 and net realizable value per unit of the finished goods is 400. Since cost of finished goods is less than its net realizable value, raw materials are valued at the lower of its cost and net realizable value, whichever is lower. Value of raw materials is 20 units into 107.75. Value of finished goods is 330 into 1200. Now for the second question, cost per unit of raw materials as per the weighted average rupees 108. Net realizable value per unit of raw material 107.75. Cost of the finished goods 330 and net realizable value per unit of finished goods given in the question is 300. In this case, net realizable value of finished goods is lesser than its cost. Hence, raw materials has to be valued at replacement cost, which is rupees 150. Hence, the value of raw material is 20 into 150, which turns out to be rupees 3000. And the value of finished goods is 300 into 1200, which is rupees 3,60,000. With this, we have completed the chapter on AS2 valuation of inventories.